Welcome to our CFP exam prep discussion about highly compensated employees in retirement planning. Today, we'll dive deep into this crucial concept that frequently appears on the CFP exam and often trips up test takers. Let's break down who qualifies as a highly compensated employee, or HCE. An employee meets the HCE criteria if they own more than 5% of the company at any time during the current or previous year. They also qualify if their compensation exceeds the IRS specified threshold, which is adjusted annually for inflation. For 2023, this amount is $135,000, looking at the prior year's compensation. Understanding the 5% ownership rule is particularly important. This includes both direct and indirect ownership. For example, if John owns 3% directly and his spouse owns 2.5%, John is considered an HCE because family attribution rules combine these percentages, pushing him over the 5% threshold. The exam loves to test candidates on these attribution rules. A common mistake students make is forgetting about the look-back period. When determining HCE status, you need to consider both the current and previous year's ownership status. Another frequent error is failing to recognize that family attribution rules apply to spouses, children, parents, and grandparents. The significance of HCE classification comes into play with retirement plan discrimination testing. These tests ensure that retirement plans don't unfairly favor HCEs over non-HCEs. The actual deferral percentage test, or ADP test, compares the average deferral percentages of HCEs to non-HCEs. The HCE's average can't exceed the non-HCE's average by more than 2 percentage points. Here's a practical example that often appears in exam questions. If non-HCEs have an average deferral of 3%, HCEs can't defer more than 5%. If non-HCEs average 8%, HCEs can't exceed 10%. Students often miscalculate these limits by applying a flat 2% rather than understanding the sliding scale nature of the rules. The consequences of failed discrimination testing are significant. Companies must either refund excess contributions to HCEs or make additional contributions to non-HCEs. The exam frequently tests scenarios where you need to determine the correct remedial action. Safe harbor plans offer an alternative to avoid these testing requirements. By providing either a 3% non-elective contribution or a matching contribution following specific formulas, companies can bypass ADP testing altogether. Test takers sometimes forget that safe harbor provisions must be in place for the entire plan year to be effective. When preparing for the exam, pay special attention to questions involving family attribution and ownership calculations. Also focus on the specific thresholds and testing requirements. Many candidates lose points by mixing up the various percentage limits or forgetting to include family members' ownership stakes. A critical point often tested is that HCE status can affect not just the individual, but the entire plan's compliance. The ripple effects of having too many HCEs or excessive contribution disparities can force plan-wide adjustments. Remember, the exam might present scenarios where you need to determine whether someone is an HCE and then evaluate the implications for plan testing. Don't just memorize the definitions. Practice applying these concepts to various scenarios, particularly those involving family attribution and discrimination testing calculations. These concepts are foundational to retirement plan administration and will definitely appear on your CFP exam. Focus on understanding the relationships between HCE classification, testing requirements, and remedial actions.